Welcome to the Gray Report. I'm your host, Spencer Gray. And if you are a multifamily investor, you want to be a multifamily investor, or you are just a veteran in the industry, well, this is the YouTube show and the podcast that was designed especially for you to keep you up to date with all of the best and latest information regarding the multifamily industry, real estate, and technology. Today on the Gray Report, again, joined by Matt Bosnagel, Director of Communications and Marketing here at Gray Capital. We've got some very interesting articles, one from the New York Times titled "Inflation has hit tenants hard, but what about their landlords?" And then a follow-up piece from the Manhattan Institute, a really interesting study addressing some solutions to some of the problems in the housing industry. We're going to take a deep dive into that, as well as reports from the Federal Reserve Bank of San Francisco, looking into remote work and how that has affected housing demand since the beginning of the pandemic. And then we've got an a rental report from Apartment List. Looks like we have some rental slowdown, which is not too surprising given the season that we are in. A lot to get into today. I'm reporting live on location out here in Los Angeles. Let's get into it. All right, everyone, welcome back to the Gray Report. I am out of town, not in Indianapolis. I am out in beautiful Los Angeles in Beverly Hills, California. I am here at a family office and private wealth management summit and conference. Looking forward to having some really interesting conversations with institutional investors, family offices, and large allocators of capital. Going to have a really interesting touch on the market. Looking forward to giving some follow-ups after some of these meetings, Matt. But we got a lot of other interesting stuff to talk about today, so there'll be time for that next week. Again, we kind of previewed what we're going to be talking about, some really interesting pieces. How's your week going? How's the office? You holding the office down? Everybody good?
Pretty good. The office is doing horribly. We are in crisis mode without you, and
crap.
We need your leadership.
Oh, man. Well, I've got confidence in you guys. I've got faith. Well, good stuff. Matt, we're getting into fall. We felt it last week. I think it was 94 degrees one day and it was 60 the next. And, we're getting into the 50s. Rents are also cooling seasonally. And, we're getting back to normalization. But then there's some calls that maybe that's more than just normalization. Maybe we're really, the brakes are being pumped in a big way kind of across the housing market. The Federal Reserve continues to go on a tear. And then just global financial markets this week just up in arms as the US dollar and the UK pound get closer to parity. That has freaked a lot of people out and led a lot of people to Googling, why does this matter? But it is a big deal. It is a big deal. We've got a very well-developed economy that is looking pretty rocky. And in context of China, Europe, the war in Ukraine, between Ukraine and Russia, more forecasts for a global downturn and global recession, which is leading investors to ask the question, what do I do? What do I do in this type of environment? And no one's got the answers. There's no playbook for the type of environment we're in right now. So I think what we're doing today, man, what we do every single week of breaking down, let's look at the best information and see if we can try to chart a course or at least get some clarity. It's not going to be fully clear, but can we just make things a little bit more understandable, and maybe we can make some really good decisions. But besides the office, Matt, how's your week going? Well, what are your thoughts? What as the
pretty
volatility?
Good. This is
you
what
personally.
Not personally, well, intellectually and professionally for sure. That's another thing too. It's like I think that there are certain groups that are affected by this more than others. I think that there are weird conflicting stories now. We're probably not going to have time to cover these stories of consumer confidence kind of ticked up a little bit, which is weird. And home sales actually had like a transient boost to home sales as well that is expected to be kind of squashed back down because of the higher mortgage rates. But there are some brief glimpses. It's like we get these like stutter steps towards a little bit more positive view, but the dominant view really is, things are getting a little bit worse. But I still don't see this single discrete slide downwards. And here's hoping that this is primarily driven by the Fed, which can then maybe yank it back. I guess I don't have any control over this, and I think that maybe no one does.
Well, I think that is the most important thing to just everyone has to acknowledge is that we of all these so many of these things we don't have control over. And then no one has all the answers, and we kind of just have to give away on the things that we can't control. I
Mhm.
mean, the biggest example in our business and just where my head's at is looking at these bond rates in the 10-year Treasury, and when you have like acquisitions going on that are based on that 10-year Treasury, it's incredibly important knowing what your cost of financing is going to be. But I don't have any control over where the 10-year is today and where it's
Mhm.
going to go next year. I don't have really a whole lot of control over where inflation is going to go. So, can we think about it and strategize different scenarios? Like absolutely, but like worrying about it, there's enough stuff to focus on rather than the things that are just absolutely outside of our control. And so much in the economy today is outside of our control. And so focusing on the things that we can control and that we can affect. What our business plans are, how we're approaching acquisitions, how we're looking at the market, how aggressive or not aggressive we need to be right now. What
Mhm.
should we be doing and looking for, and what should we not be doing and looking for?
Yeah.
There's a lot of ways to execute that would have worked out fine in previous years, but in the current environment, it just doesn't make that as nearly as much sense relative to the amount of risk that one has to take to go down that road. Again, we've talked about it before, but like bridge loans right now are frightening. And for anyone that's gotten a bridge loan in the last 12 months or so, it's nerve wracking because you have an uncapped interest rate exposure, and your debt service is going up, and we're seeing margins thinning out with expenses increasing and rents not necessarily increasing as much as they were. And so, how do you take more defensive posture? How do you be more efficient and still keep things moving in a positive direction while protecting your flank and protecting the downside?
Yeah.
It's not straightforward.
Yeah, these are the months where I really do pay attention to kind of the month to month stuff. There are trends that are still forming, and we'll see it in the rent in some of these rent growth patterns where it's like I don't know if things are going to proceed linearly, if things are going to get steeper, or if things will start to ease up. And I am pretty sure that's not going to be the last one. Yeah, I think it is important, and I think it's important to note that there are going to be some people that navigate their way out of this.
Oh
There
yeah.
are solutions, and I also think that there are people that are looking for not I don't want to say like perfect sanctuary, but at least like the best performing assets in a volatile and uncertain economy. And I'm going to advertise a little bit, but I think multifamily is probably one of them. And you know what? Another thing is, we were in a similarly uncertain moment a couple of years ago, and we got out of it. Now, I don't think this. We're not facing another pandemic, but we are facing a period of slightly, actually, less uncertainty now than we were in 2020. So, kind of knowing that we've been through this is a little bit more heartening than if this was kind of out of the blue.
In 2020, it was interesting, especially early in 2020. It was more of like this. There wasn't like, oh, we're not sure what was going to happen, even though no one knew what was going to happen. It was almost as though everyone assumed the worst was going to happen,
Yeah.
and so people were kind of taking those positions and really kind of cooled the market off. But it really froze the market. If anything, it kind of froze it in place until everyone realized, like, okay, there's this huge demand for across the board, and supply chain issues and prices are starting to move, and let's get on top of it. And then we saw 21, everyone kind of catching up to some of those changes. But if there's any bit time that one could say, winter is coming, and that there's this like fear out there for the winter months, whether it's a rise in energy and fuel prices, or just knowing that seasonally things are going to change down, and looking at the trajectory of so many of these global economies, people are just in a mindset of just things are not going to be great. And one thing I have noticed and observed over time is that the idea, people fear the downside much more than the upside.
Yeah.
And that downside can be overplayed. And I don't think that things are just going to work out completely swimmingly and we're just going to have like a perfect soft landing. But I do think that fear creeps into people's actions more than they would like to acknowledge.
Mhm.
And that affects psychology and that affects markets. Um, but oftentimes it's not nearly as bad as the worst case scenario in the way people price things in. So,
Yeah.
and again, talking about soft landings and landings, a landing means things that do have to come down at some point.
Mhm.
Just that the trajectory and how hard is it going to hurt. But to say, we're coming down, well, that has to happen. And we've known
Yeah.
that has had to happen for a while.
Yeah, I completely agree. I think that there is also and there is a non-zero amount of people that are waiting, for buying opportunities, waiting to kind of exploit things actively. As cynical as that kind of is, it's also like a hopeful. There are people still with hope. And I'll say this again. And you mentioned this last week. Is there are people that are holding onto their homes and not selling. And if it was a really scary economy that people thought inflation was run away, then they would sell today because they don't want it, because they don't want the value to go down tomorrow. Sorry, not inflation. I'm thinking of
there's going to be a
falling home
decline in
prices.
housing prices.
Yeah.
And I think that it's probably too early to say that, one way or the other, is because, there's been a lot of analogies to kind of the 2007, 2008 time frame. And specifically, right before the stock market really took a crash. So when we look at this chart, so this is the S&P 500, and you can see that, zooming in here on this year in 2022, we've obviously had this big downtrend starting really at the beginning of the year. But what a lot of folks are looking at and comparing it to is this period back in '07 and into '08 where we had this nice not nice, but we had this descent, and then it really broke through. And what people are saying, are we at the bottom, or are we just getting to that inflection point? Are we really going to start seeing the pain? And people are looking at, some of these, levels, and we're at a point basically where if, the stock market continues to break through these bottoming levels, where basically we have to go back almost, if we're at kind of the halfway point of the ascent from the pandemic, and we break through these levels, could we then go down even further and see an incredible fall in the stock market? And I think that type of financial movement. We've already seen incredible volatility in the bond market. We're seeing volatility in the stock market. That could be possibly the last chapter in this incredible kind of downswing. And I think it's not all rosy and green grass on the other side, but we may finally see the capitulation if we do see a major push to the downside. The Federal Reserve will most likely take their foot off the brake and coast, if not pump on the gas. We'll see governments and central banks step in with different types of support and stimulus, and that's usually the point. I mean, if you look back to the pandemic in 2020, when things shifted is when the governments, when they start to react, that's when that last chapter is being written before the upside. And to your point of people on the sidelines waiting for something, there's no doubt anything in anybody, and certainly not my mind, a massive amount of wealth is getting ready to be created for the individuals that are in the right places at the right times. We don't know where those right places are and what the timing is going to be, but a massive opportunity is, I believe, within the next 6 months or so. It just, can we navigate to kind of get to that point? So,
yeah, it's worth taking it and putting this into context. All of this is being caused by a nominal rate, a federal funds rate of what is it, 2.33 right now, and in 2006, the federal funds rate was in the fives. So right now it does seem like, yes, a lot of this is caused by the Fed, but a lot of this is like we're coming off of a pandemic, and I don't think that there was, maybe there's stuff that we're still having to kind of pay the bill for.
That's what,
And that, yeah,
absolutely, Matt. I was talking with Blake quite a bit yesterday, and so much of this is us paying the bills right now. And you can't just issue stimulus checks and PPE or PPP and all the different types of
both of
stimulus.
those.
Yeah, both of those, and expect there to be no effect on the economy. And we're paying for it now.
And you know what? I'm not even judging whether that was good or bad. I think that when we heard about this, it was like, well, I mean, we kind of, a lot of that, the thought of it among all these, they saw it coming. They knew that we would have to pay for these eventually. Maybe in the year since, they've been kind of diluted of that necessity.
They kind of thought it was going to be not that big of a deal.
Yeah, yeah.
I mean, it was going to be very transitory, just not that big of a deal for a while. So,
yeah.
But let's talk about how it is become a big deal, and
Mhm.
into this New York Times piece, because one, I like featuring these New York Times articles because I think it gets a much wider and broader readership than a lot of the other sources that we look at, Matt. And so this is, I think, more of the general public's kind of view of maybe where housing is and how they're being informed or influenced on kind of the state of the housing market. And this is really more about rentals and tenants and landlords. And it's a little bit of a different take. Less just numbers, a little anecdotal. So in this New York Times piece, inflation has hit tenants hard. What about their landlords? And I think it's a good title because I think everybody knows that the rent has gone up and that it's hit a lot of folks hard. But it's not just rent, obviously. It's inflation in general. And we know we've been in a housing crisis for years now. Then the byline is publicly, or not the byline, but the title underneath: publicly traded corporate landlords are reporting some of their highest margins ever, while smaller operators say rent increases are eaten up by the costs. I always think it's interesting comparing kind of the more systematized, larger managers and owners to kind of more of your mom and pops, because you do see a divergence of performance. I mean, we saw huge differences, Matt, during the pandemic, of just mom and pop landlords, just absolutely going under because their tenants weren't paying. And a lot of it, what we found out was, many mom and pop landlords just get a little too emotionally involved with their tenants, and they were giving significantly more breaks than they really needed to, and kind of let problems go on and create a mentality of maybe I don't have to pay. And you kept hearing stories of people not paying for months in a whole year.
Well,
that just doesn't happen in a professionally managed apartment community.
Yeah, the main questions that I had, well, and firstly, it's worth kind of getting the idea of what they see as a smaller landlord. And one of the ones that they actually specifically cite is this little kind of testimonial from a guy that manages a company that manages 6,000 apartments in the Houston area, which is a pretty decent number. And it's not, I wouldn't say that company is as mom and pop, but it does make me think about what decisions are these smaller landlords making that are the bad decisions? What processes do bigger landlords have? And is it even possible for smaller operations to do well right now? Or do they just not have the access of scale that larger operations larger operations do?
Sometimes, and I think a lot of it, Matt, at least in reading between the lines, a lot of it is comes down to operations and how they're operating these properties and the choices that they're making. And again, just to follow up on that individual, Mr. Verma, from the article earlier this year, Mr. Verma experimented with raising rents enough to cover the cost of spiking wages, property taxes, insurance, and maintenance. Turnover doubled in the properties where he tried it as people left for nearby buildings. And then it quotes him: "It's crushing our margins." He said, "Our profits from last year have evaporated, and we're running at break even at a number of properties. There's some who think landlords must be making money. No, we're only going up 12 to 14%, and our expenses have gone up 30%. And so, to me at least, it begs the question that there's a lot of truth in what he's saying. Expenses have gone up considerably, And you can't just look at rent growth because your expenses are going up also, and you have to look at kind of what is your actual and not net operating growth. What is your kind of your net margins rather than just what's the
Mhm.
top line growth. But at the same time, it sounds like he read the market wrong and raised rents too much and not raise rents
Yeah.
along with market. If he's losing tenants and his turnover doubled, again, that sounds like he just kind of did a little bit of a miscalculation and is now kind of doubling back on why that may have happened.
Yeah, I wonder, I'm guessing that it is. I mean, for someone that operates 6,000 apartments, I'm sure that they have some kind of rental management system or some software or something that would you can kind of dial something in. But it does make me think about the market specifically that he's in. It is all around the Houston area. I kind of looked up a little bit, and the vast majority are actually in Houston or around there. Um, I wonder what yeah, I wonder about the decisions, but I also wonder maybe it is specific to the Houston market that may just not be doing as well.
It could be, and as we've reported, I mean, Houston has seen a ton of new supply coming online, depending on the types of properties that he manages. Maybe some of those newer properties attracted some of those tenants. But yeah, it's an interesting statement, and obviously for the properties that his former tenants are moving to, it would be a positive for them. And just kind of continuing on with the piece,
Yeah.
um, eh, getting into the shape and the demographics. And it says higher earning tenants who flock to newer buildings with more amenities have been more willing to accept these rent
Mhm.
increases. But low income renters, while they're seeing faster wage growth, have borne the brunt of higher prices for necessities like gasoline, groceries. Now it says that rents in older buildings are rising at a slower rate than newer, nicer ones. And then our friend Jay Parsons from RealPage is quoted. The quote is, "The reality is that rents can only rise as incomes rise." He noted that the rent averages 23% of monthly incomes across the apartments that RealPage tracks. And if people can't afford it, you can't lease it. And
Yeah.
I think that we're running into some of those ceilings right now in terms of wage growth and rent growth.
Yeah. I think that the idea about the rising expenses weighing more heavily on the bottom lines of smaller landlords. That's one of the ideas that New York Times gives for maybe why these landlords are not doing as well as larger landlords. And they also mention, I also mentioned you kind of the choice of, are you going to get a Class A, Class B, or Class C? Maybe that choice is going to dictate how your apartments are going to perform. I also think, and this is, I'm kind of curious. They seem to suggest that value add projects. The quote is, "The business of acquiring, renovating, and building apartments may be attractive to smaller mid-sized landlords than larger ones." And in this inflationary and high interest environment, these value add projects may not be as profitable due to labor and materials costs. And then they also talk about deferred maintenance and putting off non-essential repairs, which that could happen maybe if you don't have the systems in place. And really, and more pointedly than the above reasons, they say more recently, smaller landlords have been asking for lower than market rent increases.
Yeah.
That little testimonial from the company managing 6,000 units described that situation. And I think that may be the key. However, the idea that inflation is outpacing wages and as well as rising taxes, there's a there's a lot of things that could drag on smaller landlords if they don't have the right systems in place, and if they don't have the right strategies and plans for going forward. And I think some of it is things that smaller landlords can't control, like they may not have the economies of scale. But I'd like to think that armed with the right information, that a smaller landlord can actually make it work if they make the right decisions.
Yeah. Well, and I just think that it's more of a I guess diverse group, kind of the smaller landlords. There's some really great operators, people do really well, and there's some people who are, it's kind of a hobby or a side hustle, and they're not really truly focused on it.
I also think that there is an undercurrent in this article, and maybe it's an assumption, and maybe it's just because of me reading the source, of the idea of a corporate landlord as a faceless entity that is more willing to passionlessly increase the rents without regard for the renters, whereas a smaller mom and pop it has their heart in the right place, and they're not going to raise rents even though they're going to suffer economically. And the implication is that the fact that corporate landlords are doing well in a time of inflation when so many people are suffering is a mark against them. So that's I think that that's the unstated
mark.
Reading between the lines. And I did look at the comment section, and I sometimes I like reading the comment section. It's nice.
I also looked at the comment section.
And just like a quick overview of some of their opinions, which are always valid. Some do talk about rising taxes and these additional burdens on landlords. There's definitely diatribes against like horrible landlords in specific, maybe landlords that aren't paying for maintenance and just not doing their job. There's also what I would say a tragically unsighted claim that rents have risen faster than wages for the past 40 years, which should be a conversation associated with affordable housing. That's a digression. I think there are also some people that flat out just don't like the idea of housing as a commodity. I think that undergirds a lot of this opinion about corporate landlords and everything. These people have systems in place, and they will take what the market can bear. But the implication that they are exploiting people is unfortunate.
Agreed. Yeah. People want to at times treat housing as not being driven by or they prefer it not being driven by market forces. And there's, I guess, not to answer the question with a question, but it's there's the problem is finding, developing, and implementing a solution to allocate housing resources more effectively than a free and open market. And there's really no one that's been able to develop one that does a better job.
And I think especially the idea like the wage to income, I did a little bit of reading, and I'd still need to a lot of this research. It takes a long time to gather, and I want to get one that's up to 2022, but it's a lot is in the affordable housing sector. Like that wage to income issue is not necessarily true for market rate apartments. They cited that RealPage study that says actually no, it's pretty even at this point for market rate apartments.
Market rate.
Now
it's the fringes, right?
It's
fringes. It's like the workforce housing that's not affordable. That if you call it your C-class properties that are it's someone like they might be able to qualify for affordable housing, but they're not taking advantage of it. And they're living in a market rate apartment.
Yeah, and that's not necessarily a failure of corporate landlords as much as like we have already designated this as a problem that the government should maybe be supporting, or maybe they have their hands in it at least right now. And so I'm not looking for the government to have a solution, but to paint it all as a product of corporate largesse or corporate greed is a little bit it's misrepresentative.
It is, and I think that it leads to not necessarily individuals looking for solutions, but just looking for individuals to blame. To be honest, but let's instead of blaming landlords or even the federal. Let's water under the bridge, Matt. Water under the bridge. We're here, right? We're here.
This is a solution area. This is not a problem area.
Exactly. Let's get to solutions. Obviously, the past informs us of how to go forward, but just kind of going to this next piece, which I think it's a great transition of. It's a piece from the Manhattan Institute of how to fight housing price inflation, policy menus for stopping government-induced housing woes from spreading beyond the coasts. And so this is a piece, again, by the Manhattan Institute that is like solely focused on like what are the solutions that are available to us? What can policymakers look at to try to get us out of the situation that we're in? And again, it really addresses the problem of seeing an incredible amount of price growth in cities across the country, and looking at some of the causes of what is really bringing on this price growth, and then looking at, all right, maybe how do we make it a little bit better? Matt, what did you think about the article?
Oh, I thought it was very, very pointed. It was a pointed article, very direct. I think that it is worth mentioning that the Manhattan Institute is a right-leaning think tank. So that's what their job is, to make these points, to make these kind of forceful arguments. I did enjoy some. I thought that there was a team of writers in this article, because there were some areas where it was like, oh, this could be in a political stump speech. And then they jump right into like hard-nosed details, which is like, oh, this is is a little bit
A little wonky.
yeah, but I liked it. I definitely liked the idea that you can kind of put these ideas out there, and even if you hate them, it's a really good jumping off point, and it gets you talking about, all right, what are the interests? How do we, the thing that I was thinking of throughout this whole article is, how do you balance the need for new housing with the need for new housing with the rights and concerns of people in existing housing. For example, let's say you want to build a new apartment building and the neighborhood council rejects it. So, how do you get past, why are they rejecting it? And what kind of rules can we set in place to, maybe there's another plan that we can, that we can bring people in. But if you don't do that, you get a place like San Francisco where, there is a radius of extremely high priced houses, and they can't even find, you got to get a 2-hour drive in order to get a job, in order to work there.
Yeah. And I'm currently in one of those high price cities right now. So let's just get into some of the solutions, Matt, because they do a good job of addressing the problem. But we talk about the problems all the time. Let's get into the L solutions. The first one would be, and again, I think a lot of these are not brand new ideas, but consolidated and getting some details, and some of them are a little bit new. So the first one, menu item number 1, restoring property rights by cutting red tape. I think this makes a lot of sense, and this is a complaint from many contractors, builders, property owners. Whether you own a single family home and you want to put in, a fence or make a change, or you're developing a large multifamily apartment community. But they've got 5 points. Zoning action should not be taken arbitrarily, which I think that makes a lot of sense. Depriving a person of the legitimate use of his or her property, including subdivision. Number 2, zoning regulations must be shown by the enacting body to be necessary to achieve a vital and pressing government interest. That is, for the regulation and provision of public goods and infrastructure, such as transportation, sanitation, etc. Number 3, any land use or actions that impose new limitations of the use of the property and that result in the reductions to the property's fair market value, entitle the owner to just compensation. If you're going to condemn a property, this is number 4, you've got to have clear and convincing evidence that it poses a direct threat to health or safety. Then the last one on property rights, property owners should have a reasonable and expeditious way to challenge undue regulations or delays related to their property.
Yeah. So just to kind of take a little bit of a step back, and not too much of one, but their description of the problem is as pointed as their solution, and it helps to kind of frame it a little bit. Mm-hmm. And they do talk about how the chief problems that they want to address are similar to ones that are addressed there that you've talked about, but it's bans on housing types through zoning or preservation regulations, mandates on lot size, density, parking design, and more, discretionary review, which empowers politicians and bureaucrats to dictate terms on specific projects, and then urban growth boundaries, as well as which aim at killing suburbs, and building codes, which set standards for construction. Those first 3 are kind of a little bit of what we're talking about. Specifically, I think this idea of discretionary review is one of the more frustrating elements, because you don't have rules in place, and it seems a little bit inconsistent. Yeah. And I know that all of these are driven by well-meaning people, but it's frustrating when you get these situations where, and I'll come up with an example, because it's not even the cases of clear corruption that I'm thinking about here. Like if a local authority approves his business partner's lousy development and then rejects obviously better ideas, what I'm thinking of is, let's say there's a well-meaning review board that rejects a modest but very workable development plan in the interest of, well, you name it, safety, the character of the neighborhood, aesthetic appeal, traffic, whatever. But they reject the modest plan, and then a week or a month later, the board meets to review a far more elaborate plan that's almost insulting and how it goes against this review board's values. So the board rejects it. But the company involved in the more elaborate plan has the money and the patience to keep coming back to the review board, to keep arguing its case, to hire a team of experts to make their case, etc. Ultimately, the review board is worn down and the community is dramatically changed. And again, these are well-meaning people, but an over-reliance on discretionary review could lead to these situations where it's actually the little guy who gets the short shrift. And when I'm sure the intent is to protect the little guy, and you end up with a community, a neighborhood that has something that kind of may not fit, when if you had a consistent set of rules, you could determine what fits and what doesn't, and it could be actually more equitable, which is a nice New York Times buzzword.
Yeah. No, I think there's definitely, I mean, it's a classic case of, regulatory capture, and, the big guys are gonna have the resources to kind of keep going through and making it work and getting things done. And then some smaller groups may just not have the time to they may not even ever begin. They may not start because, the environment, and the temperature of the local municipality is so cold to developers that I'm not even going to try to do something here. I'm going to go to another market that's a little easier to do.
And that was kind of part of my notes, is like, I think that of the ones that I named earlier, like bans on housing, mandates on lots, all those zoning stuff is what people avoid. I think that building codes is probably the most commonly encountered hindrance, because I bet that if developers know they have to deal with these issues, if they know that there's some review board or some powerful fiefdom with an official that rejects everyone, they're just not going to build there. They're going to find easier places. So so that's a little bit frustrating. But I think that having these set, and what you have up there had up there with this homeowners bill of rights, or it's not even, it's like this idea of having these actual procedures in place rather than discretion, and there's always room for error when you're talking about people, and
too much subjectivity.
Yeah. So having that, and just that impulse to have something written down is important. I know there are always edge cases. There's always going to be places where the rules don't exactly fit. And I'm sure that these review boards have rules of their own, but I think there's got to be something that's a little bit more clear than what we've got, especially how inconsistent it might be from community to community. And I'm not talking about places where, in the north, there might be things that are related to snow removal or salting the roads or something, and maybe a place with hills has something about like elevation, or I don't know.
Yeah.
But there are climate and geographical issues.
Sure.
I'll
and that's why it's good to be local.
But there can be consistent things that are kind of across the board agreed upon, that would aid the development of new housing.
Well, and I think that's important to know that. I mean, all this is very hyper local, and I think that this is to counteract some of the tendencies to suggest and move forward on some sort of national housing solution, because these decisions are better left to just the local zoning boards, municipalities, and so this is really again, they're saying a menu for those local governments, municipalities, and zoning boards, like, hey, here's some things we can incorporate. And taking a step back, now again, because it's a long report, it's about 27 pages. We can't get into every piece of it, but I wanted to go over, I wanted to go over just the 3 points. I got into the restoring the homeowners bill of rights, but just they have really three options. One is restoring property rights, which we got into. Then there's making housing actually pay off. And then the number third is streamlining local government. And on restoring property rights, we talked about the Bill of Rights. Then there's a housing appeals board, and being able to streamline the way you can appeal, being denied, permits. Then this idea of a permit shot clock, which I think is really interesting. Putting a time on it of, if you have a proposal, your local zoning board needs to be able to give you a response within a certain amount of time, or it's automatically approved. That may lead to things being automatically denied, but I think then you have to have some reasonable explanation to deny something.
Oh, so they can't just write that down and expect to eliminate all delay in government.
Yeah. Yeah,
But that is a nice sentiment.
it is nice.
I laughed when I read that. I was like, oh, they are going to find a way around that.
Yeah, it's all denied.
I did. Oh, sorry.
Oh no,
One thing that you talked about that I thought was very interesting. I hadn't really even thought about it. Was it was in the idea of making housing pay dividends. One of their ideas is where is this here? Where if you put in new housing, they could balance. It talks about like balancing the interests of the existing neighbors with the people that want to build new houses. And so as new houses are built, it will increase the tax base of that neighborhood. And, either, and the idea is maybe you give the surrounding neighbors a little bit of a tax break, or you make improvements to that neighborhood to reflect that increased tax break and kind of entice people to be more accepting of the new homes that are coming in there. I think that's a little bit interesting. That could be carried away and it may probably manipulated in some ways. But we do have to talk about ways to, rather than like use eminent domain or something, talk about ways to entice people, use kind of a carrot rather than just kind of fiat, just let people roll over. And again, this is the problem that I keep thinking about. It's not necessarily even the boards themselves. It is the interests of these neighbors. And there is a broad sense of NIMBYism, and you have to combat that with something that is that gives them something. Otherwise, I don't know if it'll work so well.
Yeah, no, it's a good point. And again, so a lot of really good suggestions and a very well cited piece. I would say the end notes are quite about 10 pages. Just all right. And just a reminder, you can get the full report from the Manhattan Institute, that New York Times piece, and all the reports we're talking about today, and significantly more. If you're signed up for the Gray Report newsletter, go over to graycapitalllc.com/newsletter to get the weekly report that's sent to your inbox every Thursday at 8:30 Eastern, and as well as a quick update on Sunday. But this next piece, Matt, this is the Federal Reserve Bank of San Francisco. Remote work and housing demand. Too long, don't read. Remote work increases demand for housing. Right? Did I get it?
Yeah, it is like as I was scrolling through, I was like, all right, yeah, I get this. But there is some good charts that really pin it down. It is, I think, a significant piece of research. It is, you have to have these data that upholds the speculation and the guessing. Otherwise, it's just speculation. So I like the idea that the San Francisco Fed crunched the numbers and found out that yes, remote work increases housing demand. But the key is like how much and the implications. And I think that this is it. The real stakes of this conclusion lie in the fact, and they say this in the article, that remote work has not by any means gone away and is not expected to do so, which would suggest that whatever effect that remote work has had on housing is also going to continue. Just to get in specifics, it says in the article, after adjusting for the role of migration, our estimates show that 1 percentage point more remote work causes house prices to increase by about 0.9 percentage points. That's not nothing. In their conclusion, exactly. It's like almost 1-to-1. In their conclusion, they see remote work as tied to a full 15% increase in home price growth. Also, to repeat, it's not really going away. So this is a sustained moment, and it can maybe explain some of the uptick that we saw in home prices, because now homes are having a different function. We've talked all about this in lofty speculative terms for the past couple of years, and it's great to see this, this fine point and this, this real relationship that they mark here. So bravo for the San Francisco Fed, to produce this research.
And so I guess the assumption would then be that a declining workforce that's working from home, individuals coming back into the office would decrease demand for housing. I mean, is that the same assumption that it's made if it's such a directly correlated? And then so we would assume that even though it's we're not going to pre-pandemic working from the office, working from home levels, if more individuals just on a percentage basis are going back to the office, we should see some of those declines in housing demand in general.
Yes. What I think is particularly interesting is that the main decline in working from home happened from really right the moment kind of where I'm going to have to guess here, but it was like late spring, early summer of 2020 down to late down to like the fourth quarter of 2020. That is when we really saw a falling off of remote work, and we really saw a lot of people return to work. It was at its peak, above 60% were working from home, and then it shot down to, at the beginning of 2021, it was about a little over 30% were remote working. And guess what? It's about a little over 30% right now. It's gone up a little, it's gone down a little, maybe it's a little under 30% now, but it's definitely not the steep falling off point. And, from 2021 to now, we've seen a lot of home price growth. And that's where, so I think there may be a little bit of a lag in terms of when the home prices grow, versus, when we've seen versus like the sustained demand from remote work. But like it's here to stay, it seems like.
And so, Matt, do you think this is more of just people, the value that they're placing on their home and where they live and their space, and the spaces that we live in? It's the home, it's the office, and then there's talk of a third place as well. Whether that's like the park or the bar or whatever. But like the home, more emphasis than the workplace, and just there's more attention focused on it. Not always necessarily I need more space, but maybe better space. Something. But I guess the question that you ask, Matt, is that relationship and the shifting in the value of like where I live, does that have legs even if you start working back to the office?
So a couple years ago, I was kind of thinking in those area terms. It's like, well, there's a sentimental value, and home buyers aren't buying, on cap rates or anything like that. They're buying because they want the home, because, there's an emotional content to it. There's an emotional content to the greater value. I think when we were when it was kind of locked down, that's a lot of discussion. I'm thinking more and more, it is like the financial, the kind of bare bones. All right, I'm building an office in my house. I am dedicating this space to it. It is a concrete kind of economic decision that there's a space in the home now that is functioning as the office, and that has a discrete cost now. It may not even be like I think and value it more. It may just be we need that space in the house, and it's becoming more valuable, and there's more demand.
I'm going to be doing some work from home at some point. I need to have this dedicated space.
Yeah.
But does that how much of that demand was pulled forward in the pandemic? And then we pulled forward from those future years.
Yeah.
Like, did everybody get that extra space in 2020 and 2021, and they're good?
Yeah, that's well, and I don't know if that's the case. I don't, but that's one of the major questions that I thought about when I was reading. And there's a couple more reports that we'll cover about the state of the apartment market. But I think that the fact that remote work is sustained and this housing demand will be sustained, I don't think we're going to have like a reactionary dip that's kind of underwater. I think that because these are the new situation, this is a new situation, we may see a bump up that kind of stays there. That's my the Fed's gonna prove me wrong, and I think that's a really big factor right now.
Yeah, we just gotta
get
out
of
the way.
Talking about remote work, I don't think that the people are going to realize, all right, well, now I hate my house, I'm going back to the office. Remote work will gradually decline, but it's not going to go away.
Well, I'm curious, Matt. I'm just bringing up another article that wasn't necessarily in our reports from August 23rd. This is from CNBC, although I'm not sure if they did the initial report. The report was done by a recent survey from Clever Real Estate, and it says that 72% of of home purchasers in the last several years, 72% are having regrets about their home purchases. And then 30% of those respondents have said that they believe that they spent too much money buying their home. So, it's interesting. I think there is some buyer's remorse, but how much of that is linked to the way that those homes are being purchased, quick closes, no inspections, the crazy over ask. They were just in this emotional frenzy, and then they're like waking up, like they've got the hangover, and they're like, what did I just buy? I just like paid over asking for a place that I have to put more work into it. It's falling apart. It's old. There's always stuff at a house that doesn't work out the way you want it to. Yeah. But are they stuck because they still got a low interest rate, good payment, housing? The other options right now, they'd have to take a major haircut and downgrade. So it's an interesting environment.
Yeah, I would say so for sure. Especially considering that situation, like we're not at that place where people are trying to sell because they think tomorrow is going to be cheaper. But I'm wondering if that, or when,
if they did, where would prices haven't decreased to a point of where do you go now? If you sell, if you think there's going to be a 10% price decline, well, your house may be up already 10% since you purchased it. But if there's going to be a 10% price decline, you sell now, that decline hasn't happened. You still have to go somewhere. Yeah. So what do you do? And then with the mortgage payment that you'd be paying, you can buy almost, maybe a third of, 2/3 of the house or half of the house. So it's not too great of an option. But let's jump into the rental market, Matt. Let's look at this recent report from Apartment List. Looking at the national rent report for September 26. So very recently. No surprise, the national index fell by 0.2% over the course of September, making the first time this year that the national median rent has declined month over month. Matt, you're saying you're tracking the month over month numbers. Yeah. We've got them, and we're seeing a little bit of softness. It's tracking. Yeah. Let's go back to this rent growth going back basically 2018 through the current year. Still elevated compared to pre-pandemic levels in 18 and 19, but just a fraction of what we saw in 2021, but not a big shocker there.
Yeah, it's interesting looking at last year. So in September of 2021, rents were still flying high at nearly 2% month over month, 10 times the growth. I'm sorry, on the other side. But then they went down. There were still seasonal effects in 2021. So they were nearly 2% month over month in September 2021. And then it shrunk to under 1% by October. And then there was nearly zero growth in November and around to negative 0.2% that December. So really, rents have been growing since January of this year, but they haven't had, it hasn't been like 2 years solid of all these growth. There were still seasonal effects that happened. And what this month does look like is, if you dial it back, is a pre-pandemic year of 2018. It's almost exactly the same, maybe a little bit better. That's what we may see for this winter.
Yeah, that's a good point. Yeah, looking back at 2018, Matt, we started seeing kind of those seasonal declines start in September as well. And then in 2019, it was the same thing. And in September, typically we start seeing seasonal declines, and those seasonal declines going back to 2018, 2019, we're slightly more than what we're seeing this year. You would think if we were seeing some type of true like pricing correction, we would see that the declines be relative to the growth. So this really seems more like seasonal activity rather than any type of major pricing correction. But again, we still have a lot of there needs to be a lot of more data points to print before we can really start making any definite conclusions about the trend.
And this is what I was talking about when I was thinking about, well, what are we going to pay for? Not necessarily economically, but are we paying for these rent increases? I think that it wouldn't be looking at the current economic situation with inflation and interest rates driving down housing prices, even like putting that aside, it may not be a bad prediction to say that every action has an equal and opposite reaction. We saw a mountain of rent growth in 2021. We could see a value coming up this winter. But I don't think that Newton's third law applies here because housing demand is more powerful than physics at this point. I'd be a little inclined to factor in this balancing and correcting when looking at rent performance in the coming months. But I don't think that things are going to completely flatten out and go negative and really fully zero out the rent growth that we saw in 2021.
Well, I think that there's a feeling amongst apartment owners, and this I'm saying this anecdotally from our own portfolio conversations with other owners, that there's an acknowledgement of like, all right, we've moved pretty fast and we've tried to track the market and rents have moved quite a bit. Mm-hmm. There's no real margins are tight, but like we need to be careful, especially going into winter months and just showing with the occupancy. When we're still 90. And this is what happened. Back in 2021, you see, as we were increasing rents, we just looked at the graph of the rent increases. Mm-hmm. We also were seeing occupancy go up and up and up. Typically, when you raise rents, if you're really running into lower demand, you see your occupancy is going to go down. But it's if your building is 99% occupied, you've got a handful of units, like you're going to charge the premium in the market because you don't need to get them leased out. You're overachieving your numbers already in your budget. Mm-hmm. But what we've seen so far this year is a little bit of a correction, not a full correction, but at least kind of a swing back the other way in terms of occupancy and vacancy. And as we approach these winter months, and sophisticated operators are keen on this. We know we're not going to basically around, we've got up until Thanksgiving, and it's up until August. If you're not really fully leased up before August and before everyone goes back to school, it's going to be a challenge. And you've got we've got a little window right now, so people are still leasing, but not nearly at the same rate. You've got Thanksgiving coming up. No one's leasing during Thanksgiving. You might have a couple leases being signed kind of between Thanksgiving and Christmas, but like December, nobody's signing leases. Nobody wants to be moving in December. So you have to be comfortable with your occupancy in September. You have to be comfortable carrying that through really until March and April, when things really start picking up again. And so we're seeing occupancy kind of soften a little bit, and we're looking out at 6-8 week projected occupancy at properties, and you see it trending down. You start saying, hey, why don't we take the foot off the gas, maybe make some concession. Let's get this place filled up. Like, we've gotten great renewal rates. We've gotten great rent growth. Let's just get it occupied, get revenue coming in, because we just don't know what the next couple months are going to look like. And so I think that is what is really going on right now. Apartment owners being satisfied with the rent growth that they've seen, but being cautious for the future and going into the winter, and preferring to get it filled up at still elevated levels. But they're saying, look, I raised rent, rents are up 15-20%.
Yeah.
Okay. So instead of instead of the 20% increase, I'll get the 15% increase. Well, and that's a lowering of their market rent.
Yeah. And I wonder if this calculation has anything to do with, there's another article in Berkadia this week about how Class A apartments are doing a lot better in terms of rent growth. But they have a little bit lower occupancy. There's almost like whether it's an acknowledgement by the landlords or whether they're seeing like delinquency or other, but it does seem like there is a barrier to the growth when it comes to B and C apartments versus A, and especially kind of Class C apartments.
Do you know, Matt, and we'll get into that report next. Do you know in that piece, when they're looking at Class A, are they, I guess, in terms of occupancy, are they parsing kind of projects that are in lease up versus completely stabilized? I assume they would probably separate those, but because that would be a big difference that can kind of screw up occupancy numbers. If there's like a property in lease up, obviously it's like, it's 25% occupied because they just open the doors, and that's going to throw off your averages. But guys at Berkadia are smart enough to.
Yeah, I'm guessing it's controlled. They don't have any information on that, but on specifically, what they do to make sure that they're pulling from a similar. But
Well,
I just think
let's
it's
jump.
interesting, David.
I let's jump right into that Berkadia piece. On the apartment list piece, the things that we didn't cover were some of the fastest growing, slowest growing metros, and just some more local data. So again, I'd hop on over, sign up for the Gray Report if you want to get that sent to your inbox, or just pop over to the apartment list and check it out. But obviously, you go to the Gray Report and get all kinds of other useful information. So just talking about this report from Berkadia, Class A performance. After a year of continued recovery from the effects of the pandemic, apartment rents experienced exponential annual growth. Nationwide effective asking rents jumped 14.8% from 2Q21 to 2Q22. Much of the surge of the last year was driven by continued demand and growth in the A-class space. Matt, is luxury where apartment investors want to be right now?
It's hard to say. It's hard to say no to that. I do think that it's worth noting that in the beginning of the pandemic, there was a period of time. I don't know if it was beginning or in the middle. It all falls
pandemic times, the before times.
There was a time, let's just say, in the past 2 years where Class C was actually performing a lot better. And it was a little bit counter to everyone's predictions of a K-shaped recovery. But now we're seeing the opposite of that. We're seeing Class A doing a lot better, and the occupancy is lower on these Class A apartments. And as you go up to Class B, the occupancy is a little higher, and Class C, it's a little bit higher. Now, again, we're talking about above 96 occupancy for Class A and 97.5 occupancy for Class C. So it is a little less than 1.5% difference, but it is, a measurable difference between these three types.
Well, one thing that's not mentioned in this, and because we're looking at physical occupancy, is economic occupancy related to bad debt, and collections issues at Class C properties, which you don't see nearly as much in Class A properties. And also, Matt, on your point about in the middle of the pandemic, Class C in kind of workforce housing was shown to perform well, but was that really true performance, or was that stimulus checks being sent out? Was that eviction moratoriums? Was that rental relief in that type of activity, rather than the actual performance of the properties and the strength of that demographic base? I think it's more the influence rather than the actual fundamentals.
Yeah, that does. I mean, considering the fact that how kind of transient it was, it does. I think your argument does
probably right.
Has legs.
It's probably like the week that the stimulus checks were. Of course. Well, back then, in 2020, we were like, well, at least in like lower cost metros, like in the Midwest, your stimulus check was more than the rent. It was like much more than the rent, and so there was like, there's no reason why anyone can't pay.
Jay Parsons has said this, the rent growth that we're seeing right now is lagging, but CPI is behind the times. So we may see stuff that shows up in inflation reports that isn't really real. But we've already reacted to it. Yeah.
And then just because you mentioned Jay Parsons,
we're flowing really smoothly today, by the way.
We try to. Again, I really appreciate Jay Parsons' insights, and he was quoted in the New York Times piece that we mentioned at the beginning of the show. I mean, leasing activity is down, and in general, the demand is quite weak. Quite weak in general. He's saying, to be clear, the market isn't collapsing. Vacancy is still below 5%, but it sure is softening. All the headlines right now are focusing on rents, but they're missing the forecast of the trees. And leasing activity was weak. I mean, you can post whatever market rent you want, but how many of those leases are you actually signing?
Yeah,
vacancy and resident turnover are increasing. And that is true. Asking rents will fall slightly in September, but that's not too unusually seasonal, as we just mentioned. And he says, as we've mentioned, it's too much is being made about the cuts, at least so far. He says the real story is demand. And then number 4, we're seeing a slowdown in demand across all asset classes and across all markets. So there's no one's really being spared. And he says, volatility works both ways, specifically talking about Florida and some of these high growth Sunbelt markets, whether it's Phoenix or Tampa. What comes up, must come down to some relative degree, and volatility is volatility. And then the last point, the Fed's making their impact they want to make. They wanted to soften the housing market. They wanted to decrease demand.
Yeah.
And, they're swinging a big stick right now, and they're being pretty damn effective at it, if I do say so myself, Matt.
Yeah, just to quote Jay Parsons here in full here. He says, make no mistake, the Fed is having its intended impact, at least on rental demand and rents. Rental demand started hot in Q1 and has been waning since Q2 after the Fed's first rate hike in the second half of March. Month over month rent increases have followed suit, coming in far below the record hikes seen in 2021. Anyone suggesting otherwise is looking at lagging data. Rents are no longer a major driver of inflation. Jake Parsons actually commented on this lagging data angle in a separate LinkedIn post last week or a couple weeks ago, but it's worth a little contextual information here, and I alluded to it and when we were talking about the Berkadia piece. Essentially, the CPI measurement inflation, which for better or for worse is the most prominent indicator of inflation that we have and that kind of policymakers follow, is demonstrably like one of the most lagging measurements of rent inflation out there. This means that we probably will see rents as a driver of inflation as measured by the CPI, but Jake Parsons argues here that we're past that now. CPI is a snapshot of too far in the past, too far removed from the now really fully moderated rents of today. And I don't think this is a sobering take on the multifamily market, as much as it's like it is time to kind of be a little bit more defensive and realize that that rents are moderate. They have normalized at this point. And I was looking at the growth trend lines from the apartment list report. We are even basically with the trend lines for pre-pandemic levels. We may see a typical seasonal decline, but if that thing goes down, if the decline kind of accelerates, then it's a little bit more problematic. But and this is just taking the apartment list numbers, if we follow similar pre-pandemic trends, we may be looking at about 5.3% rent growth by the end of the year. And that is measured against apartment lists pre-pandemic average kind of. Their 2018 numbers was 3.5 instead of 5.3. So again, we're more than 1.5% over typical averages, which I think is really great. But that's, again, if we're seeing something normal. And I don't know, I don't see a big, other than the Fed, I don't know what's going to cause things to really tank as far as they've come up in 2021.
Well,
maybe
we'll see. We'll see if there's any more pipelines get sabotaged out in out in the ocean. I think there's some geopolitical risks out there that are relatively hard to quantify for us. But it's going to be an interesting couple months, Matt. So, all right, this is a great selection of reports. I mean, a lot of it is sounding negative, but really looking at the alternatives, multifamily still seems to be very stable place to be, even with some declining demand and some softening in rent growth. I forget who I was having the conversation with, but it's like all asset classes essentially. I've seen some kind of decline. It would be very suspect for real estate to not have some correlation. It's not nearly as correlated to the stock market as some other assets, but it is correlated to the general global economy to some degree. And the price of declines we've seen in real estate, especially in multifamily housing, have been some of the most moderate anywhere in the economy. And there's question marks on every asset class and every strategy right now. And housing has a little bit much more legs under it compared to quite a few other investment ideas and theses. So I think, kind of in conclusion, having a long-term view of the housing market is the only way to look at this. If you have a short-term view, wanting to do something, very quick, the risk is extraordinary right now. You want to be able to hold on to the long-term, having that 5, 10, 15-year time horizon, I think is incredibly important. And I'm sure we'll be in a completely different place in 3 months and 6 months from now. And we'll take it one day at a time, 1 week, 1 month at a time. But keeping the eyes on the long game.
Yeah, I think you lose if you think that the bad times are going to continue forever. Really realizing and trying to figure out the outline and when this bad times are going to be over potentially
Yeah.
is where you'll kind of succeed and be able to survive this.
But I agree. But it gets darker before the dawn too. I think
Yeah.
before it gets better, it's going to probably get a lot worse.
Hmm.
But it's not going to be bad forever. So
Yeah.
we'll just get through it one day at a time. Um, if you like what you heard today, make sure you're subscribed to the YouTube channel. You're getting the podcast, and you're signed up for the newsletter. Those are kind of the three. That's the trifecta in terms of like how to get all your information from Gray Capital and the Gray Report. If you're an accredited investor, you want to take the next step because we are navigating through this market with that long-term perspective. Pop on over to the Gray Fund's landing page, gray.fund, type it right into your browser or on your smartphone. Again, investment opportunities only open to accredited investors. This isn't exactly an opportunity to invest, but if you'd like to check it out, learn some more about it, and pop on over to gray.fund. Matt, thank you once again. This has been a great show. Thanks for keeping things moving and rocking a Great Capital HQ back in Indy while I'm slaving away here in quite sunny Beverly Hills, California.
Beautiful.
All right.
I envy you.
Yeah, well, we'll see. I've got quite a few meetings over the next couple of days, so be careful what you wish for. But I will have some interesting insights. I always gain a lot of information talking to some pretty sophisticated, large institutional investors. So next week, I'll have a good report for the viewers and listeners.
Awesome. Thanks.
Good stuff. All right. Have a good, Matt, everyone. We'll see you on the next episode of The Gray Report. See you soon.